All right, ladies and gentlemen, apologies for the delay there. We just had to add another chair and add another individual to the panel. We now have 5 speakers presenting here on the first panel of discussion. From left to right, in that order, we have Mr. Rad Al-Khader from Equiti. We have Omar Karuti from ADSS. We have Amaranth Rath from CMS. We have Wael Makaram from ICM. And Mohammed Al-Qudsi from CAPEX. So, gentlemen, I'm going to be asking simple questions and just looking for a 1-minute response. In return, you need a microphone. All right, we're going to be getting you a microphone. Look at that. Fast as fast can be. Give it up for my audio team. All right, gentlemen, the first question that I have, and again, ladies and gentlemen, the topic of this discussion is FX trading in increased volatility and during this crisis we're facing here. First question, gentlemen. How you see the market in the last 2 quarters, especially with high volatility and with crisis situations like the one we're dealing with. Mr. Raed?
Thank you so much. Thank you for coming, guys. I think the last 2 quarters, if we can speak about the third quarter first. The third quarter showed volatility, and with the volatility comes always the opportunities. So as traders, we all they look always to trade those opportunities. And in the third quarter, we can say the booming sector was the technology. Every stock is related or market related into technology. Act very well based on the boom in that sector with the pandemic. While the fourth sector, we witnessed the biotech taking place. And with those high volatility, always traders dream about this kind of volatility. I like to have it more often, because with the volatility, there is a good opportunity to grab a wider range trades, like longer take profits, or far, a little bit far take profits. And this is by itself, it's an opportunity. It should be taken by traders, and they keep searching all the products in the market about it. So this is the story of the last 2 quarters. Looking for the coming quarter, maybe the vaccines will continue affecting the market harder.
Yes, hello everybody. Thank you for coming. It's been a crazy ride this year with a lot of volatility. We've witnessed historic events like the oil crash and actually it going into negative. And while that hurt some clients caught on the wrong side of it, it created, a great buying opportunity for others. I touched upon the equity side of the business and the US indices. At ADSS, we offer a wide range of products, and we've seen a big uptick in 2020, particularly in the last 2 quarters, when it comes to trading in single stock CFDs. Obviously, there's a big hype now on, electric car companies like NIO, like Tesla. And with the news surrounding the vaccine, there's the pharma stocks such as Moderna and Pfizer. So, from the brokerage side, we've seen a lot of uptick from clients kind of adding and diversifying into single stock CFDs. From the brokerage aspect, I believe it's probably commonly shared by most brokers. With volatility comes, trading opportunities and trading volume. And that equates to, an increase for revenue. So overall, I think it's been a fairly good year for brokers in general.
Hi all, thank you for coming. In terms of the year, obviously, as Omar mentioned, we've seen historic events out here. The pandemic, which is very unfortunate and has struck the globe, and most of the industries are suffering due to that. And let's be honest here, our industry for that matter was in a way immune to it. In fact, it was more like a blessing in disguise. The COVID came in for the Forex industry because the volumes have surged suddenly. At CMS, what we found is in the last 2 quarters, the number of new accounts opened has been record high. The volumes have touched, humongous proportions. And we found a lot of new people coming in who want to learn about trading. I guess they are at home, they want to probably invest in learning of trading technologies and all that stuff, and then probably try and make more money and have an extra income stream by trading. Oil obviously has been a hot topic out here, a lot of clients trading on oil. But what we've seen is, at least from our perspective, that the kind of volatility that the FX and the gold has shown, a lot of clients tried to pounce on that and did a huge amount of trading on that. So overall, while we hope that the situation improves globally, from the Forex industry perspective, I think we've had a good 2 quarters, and I'm sure it will be probably shared by most of the other brokers as well.
Hello, everyone, and thank you all for joining. First, since the pandemic has started, the market was so rewarding. We saw a lot of opportunities in many asset classes. First, ahead of the pandemic, we started seeing low volume trading in most of currency pairs. But however, when the pandemic has started, it triggered a lot of action from central banks, and this just injected so much funds to the market. And these funds flew to different classes, to FX, stocks, commodities, and even crypto witnessed some flow of funds. So this just created a lot of opportunities for clients to trade. However, a key thing would remain for a client, and it was one of the key struggles for clients, is just to know how to manage such volatility. Usually volatility carries a lot of opportunities, but definitely everyone is just also afraid of these volatilities, since the market's going to move a lot faster than they're got used to it. So this was one of the struggles. However, in terms of brokerage business, a lot of clients just entered the market. They were seeing a lot of opportunities. We saw a lot of rally in stock indices, which rose almost 30% since their bottom, and even more. Even currency pairs, they moved 5 to 10%. So these all are some good opportunities for clients, and this drove a lot of volume into brokerage firms.
Yeah, hello everyone, and yes, I share the same point of view with my colleagues, and I would like to add something very important, which is the quantitative easing program that all central banks has started because of the pandemic. Has helped a lot the market, the bullish market move, and also the stimulus package has helped a lot also to reduce the unemployment in the US especially, and in Europe in general. So what's next? This is the very important question, and the market might keep rallying thanks to the vaccine, thanks to more, maybe the vaccine, if people has respected taking the vaccine, because I've heard a lot of people were very skeptical of taking the vaccine, so that might reduce a little bit of the market recovery. However, if everything went in plan, I think that the bullish movement might keep going on for the next quarter at least.
Excellent. Beautiful responses, gentlemen. Let's try question number 2. What important advice would you like to provide traders who want to trade in FX, CFDs, and stocks during the current situation?
Well, the traders, now the information is available for everyone, and the market is at the highest transparency level ever, price reflecting almost all the actions happening in the market. What traders should take care about is the risk management. Risk management is knowing the exact size of your trade compared to your balance and equity. Risk management is knowing exactly the product you are trading on and what are the advantage of it and disadvantage as well, and the terms and conditions of the trading on that product. Like such a product's derivatives in the market faced a lot of change and instant change due to the pandemic effect and negative effect on the market and the high volatility. So following up with the notifications and the e-coms coming from the provider or the brokerage firm, pairing up with the market and the news that affecting the product that he's trading on, and also knowing the margin requirements and the trades aspects about the product that you are trading on is very important to protect yourself first from yourself, from being greedy or being not up to the news and updates about the market regarding your trades, and at the same time just like look into the technical side of movement, because technically with with volatility is your key to enter and exit the trades. Don't look only about the fundamentals. Thank you.
I mean, first and foremost, obviously, knowing the product, knowing what you're getting into, doing your homework. Otherwise, I would summarize it into two key points, let's say. First of all, discipline, which is very important, and being aware of market news. During volatility, a lot of traders prefer to day trade or trade on more like short-term periods, and having strict stop losses and take profits for your trades to protect you in case you're on the other side from a breakout that is caused from certain fundamentals or news that's coming in the market. Just to bring back the point of the vaccine, we saw what that news had an effect on the market, the progression of the development of the vaccine. People became extremely bullish, and U.S. indices hit new highs. Yeah, I think that's it for me.
I concur with my fellow panelists, and just to add, on normal market conditions, a lot of people use the technical charts to trade. But when something like this happens, all the trends analysis, the risk indicators actually go for a toss. So one has to be very prudent when one wants to trade. So for a trader, and especially a new trader, I would say that should concentrate probably on the major pairs and not get into exotics, because the volatility is probably a little better there. I mean, it's not as wide as exotics, and the liquidity is there in the market. Because in such extreme conditions, invariably what happens is you also would probably experience a little bit of slippage in the price's execution when you do it. And to take care of the slippage, what we suggest, at least to the traders, is instead of market orders, you should probably go into stop or limit orders, where at least the slippage in that way is taken care of. And as the others mentioned, in terms of the risk appetite that you have, you need to be sure what risk appetite you have and play accordingly and be focused and determined and just stick to the plan that you have.
So one of the key advices that you should take into consideration, you have to have as much as you can access to information and knowledge. Since at the beginning, whenever you want to decide on any of the investments that you want to get in, you have to know what's everything behind the product that you are trading, whether it's FX, it's stocks, it's commodities, or any other asset class that you're trading. So this is number one. Second, definitely since we're encountering sessions of high volatility, we have a lot of uncertainty around Brexit. We have also the pandemic. We're still in. We still have some couple of months to make sure everything can be all right. So these are also adding a bit of stress to the market, and this would definitely affect the performance of traders. So what you have to always do is just to combine the latest in information, what we call fundamental news, fundamental analysis. So you definitely need to watch out for these for the indicators, for the headlines that come out, since they're affecting the market heavily, and everyone from central banks to traders to big traders, they are all waiting for how the economy will develop. So definitely you have to watch out for all the releases. They are so important, and you have to take into consideration what they mean to the future of monetary policy and fiscal policies by governments, by central banks that are affecting the market. And then you can also move forward in order to execute your trades and make sure that you're on the right path. Also, you have to go for a proper technical analysis. Use the proper indicators that suit the current market conditions. Especially when we have volatility, we have some trends going on. You have to use, for example, trending indicators and not go for some indicators that could show whether the market is overbought or oversold ahead of time. So these could be good steps to work out with. And definitely risk management remains key for success in trading. You shouldn't over leverage your trades. You always have to keep a good room for yourself to just assess your trade if you are in a losing trade. Thank you.
Thank you. All of the above. And I would love to say also that as a trader, I need to keep an eye always and all the time on the development of the trade. I.e., I have to keep following my trade, in the meaning that if I place a stop loss and the market moves with the current or with the trend of the trade, I have to follow my my trade or my transaction, in the meaning that I have to move the stop loss following. So if the market reverse on my transaction, at least I have to keep myself in the safe zone. This is first. Second, as my colleague has said, I have to be well informed, very attentive to the market update. I have to follow the central bank's risk events. Even the data release, the PMI in Europe was magnificent yesterday, and that created a very good move on the euro. So I wouldn't say no for anything. I have to keep an eye on everything, and I have to be dismissive in my trade. And also, I wishful thinking, I have to stay away from it. I don't want to say to myself that I want to prove myself right in my trade. However, the market, the big certainty in the market is there's no certainty. So everything that the market is doing, I have to follow it, and I have to be the friend of the trend.
All right. So, gentlemen, 90 seconds, your response to the next question. How should risk management be followed by traders when comparing trading in normal days and during high volatility?
Well, high volatility doesn't mean that there is a more risk, to be honest. It's the same conditions always, but it means more entries, more exits, more often trading. What does that mean? It means that you need to stick to your principles of having your stop loss and take a profit, knowing the size of your trades, exiting and be realistic with your targets and your stop loss. In the high volatility markets. Also, the high volatility markets, as I said, it's like more frequent trading, more number of trades that could generate in a shorter time. But at the same time, you need to be following up with the date and time of the news that could move the market. And if you don't know, you should close your positions right away when you feel the volatility is harmful. What is the meaning of harmful? It is like fluctuating between your direction of your trade and against your trade with a wide movement. Then I believe that either if your trade is realistic in the terms of size, then you can keep it until it touch one of your boundaries, take profit or stop loss, and keep the ratio of your success ratio, like the return to risk, always positive in terms of the return to protect yourself in the high volatility market. This is my opinion. So,
we all know when it comes to trading, one of the biggest battles that traders face is emotions, and that's amplified, during volatile times. The best advice I can give is if you feel that your emotions could potentially get the best of you, take a break, step aside, reassess the market maybe in the next day. And since when the market is volatile, you're seeing bigger moves in shorter periods of time. I would advise shorter time frames of trading, and again, touching on the point of strict stop losses and take profits. And if you choose to trade in a more long-term strategy, it's very important, again, not to over-leverage. So I would decrease the usual size of positions, again, because the moves are much bigger during a shorter time frame.
I think it's most important that one defines the risk appetite that one wants to take. How much of the risk does the trader really want to take on a trade? If he makes enough money on a day, he knows when he should stop. It's not as if you become more greedy, and the same thing goes for the losses. If you have made sufficient, let's say, losses in a day, you need to take a break. It's always the head versus the heart who rules in such trading things. In terms of the stop losses, which are anyway important, whether it's the normal market conditions or on volatile market conditions. Probably on volatile market conditions, it's more important the stop loss and take profit positions. So if I can bifurcate into two, the novice traders and the experienced traders, probably for the novice traders, you have a strict, smaller stop loss and take profits, because then your profits may be lower, but your losses are also lower. But because there are huge swings in the volatility, because of the volatility in the markets, for experienced traders, the stop loss and take profit can actually get widened. Because because it is volatile, once it goes down, it will probably come up at the same or a faster rate. So if you're an experienced trader and you can actually increase the bandwidth of your stop loss and the take profit orders, you probably will stand to gain here. Because of volatility, obviously, is a huge opportunity, but you have to be focused, determined, and have to have a proper risk management system to ensure that your success rate is high.
Unfortunately, most of the brokers, they offer high leverage, and clients, they are always seeking this high leverage in order to have higher profits. However, this is not the case with higher market volatility, since when you see, for example, let's take into consideration a certain calculations for how your trading account should be. For example, a client opens a trading account for $10,000. Most of the clients will just go and risk all of their account on a couple of trades. However, some other smarter clients will just risk a certain small amount, like for example 5% of the account, and set it as if it is the initial account or the main account, and trade it and have all the 95% as a backup account. That's what most of successful traders do, for example. What comes into how to trade these 500 or the left 5%, it is changing with the current market dynamics. If you just have a quick look on the average true range, which gives us an example on how the market is performing recently and the volatility. We witnessed back in 2018, 2019, some currency pairs, for example, having 50 to 40 pips on the day. But now we're seeing almost 80 to 100 and even more pips being traded every day. So this would have definitely an impact on your stop losses. We always hear people saying you have to set your stop loss at 20 points, 40 points. There's no just certain level, certain stop ratio that you have to give for your trades. What you have to do is always assess how the market is performing. For example, if you were trading Dow Jones, taking one lot on Dow Jones previously when it used to move 100 to 200 points a day wasn't big of a risk if you're having a very high account. However, if you just to trade one lot currently, you can have a P&L in a day, for example, $5,000 to $10,000 in one single day, which used to be almost a couple of months trading performance. So definitely take consideration for these facts.
Yeah, I agree with everything my colleague has said, and I would love also to say that the leverage, when it comes to high volatility, the leverage might be a double-edged sword. So we need to pay an extra attention and be very conservative with our election of the leverage. This is first. Second, also I have to use a very strict system when I set my stop loss. And going back to the point that my colleague has been saying, there is no, let's just say, a rule to set a stop loss like 20 or 30 or 50 pips from the entry point. However, there is plenty of, let's just say, tricks that you can use. For example, some people, they use the ATR, the average true range, so they can see the volatility of the market, how's the market's been moving, if it was in intraday, in 100 or 200, and some people, they used to put like 2 ATRs or 1.5 ATR. So that, my advice is just to be very systematic and scientific when it comes to my trade and not to be random, and to pay extra attention to the leverage when it comes to high volatility.
Excellent. We'll start the next question over at your side, Mr. Mahmoud. So what insight would you care to share with traders to help build a trading strategy that can withstand any market conditions?
First, we have, as a trader, to take into consideration the macro and the geopolitical situation, and I have to pay attention to the speciality or to the privacy of each market. So we can't trade every market the same way. Second, I have to use technical analysis, setting my entry points and my exit points on support and resistance levels. I have also to diversify my portfolio, in the meaning that I don't have to focus on specific market. I have also to reduce my exposure to same assets. For example, if I'm trading euro-dollar and I'm trading cable, so in that case I'm exposed to the weakness of the dollar if the dollar has been weak. So I have to take into consideration to reduce my exposure to the same asset. Also, I have to take into consideration the correlation between assets, and everybody knows about the correlation, the negative correlation between the gold and the US dollar. What else? I have to pay attention to my account size. So if my account size, I have to take into consideration also how my psychology, for example, the greed and the fear. So if I'm very afraid from the market, I have to step aside and stay until this fear goes out. So that's it in a nutshell, what I can advise any trader to if he wants to trade the market.
Thank you. Mr. Well?
Okay, so in order to have a proper trading plan, first of all, you have to ask yourself a question whether you can afford the risk that's within this investment. That's the number one thing. And based on the risk that you can afford and based on the time that you can give for this investment, you have to set your trading plan. But also when it comes to setting the first point of your trading plan, other than these questions, you have to go for to be prepared psychologically. Whether you can you can hold the market risks. If the market is moving fast and you are in a fear mode, it will definitely trigger you today to do some actions other than the ones that maybe could be successful. So this is also a key point. You have to make sure you're psychologically ready to trade the market. And then we move to executing a trade and to go for risk management. As I said, you have to just risk part of your account, not full account, on certain trades. Keep part of your account as a backup. Then you move to fundamental and technical analysis. You have to assess the market dynamics. The market dynamics are changing really fast. And as my colleague said yesterday, for example, one of the indicators was able to spark a bit of a move in the market and change a bit of expectations for the coming year. So these are, this is key, fundamental analysis. And then into executing a trade, definitely you have to have your set of proper indicators. You have to mix indicators, trend indicators, momentum indicators, those that could show you proper volatility, whether the market is in proper conditions to trade. And based on this, you have to get a little bit of every of these key points, and then you could be ready to trade at least for a while. Thank you.
I think the key is initially the products. You should be comfortable with what products you are trading. It doesn't necessarily mean that if a trader is making, let's say on currencies, has a good success rate, doesn't necessarily mean that you'll have the same success rate there unless you know the product where. So you need to define the asset class, and within the asset class, what products you would like to trade. In terms of the trading, always go for lower leverage. A higher leverage, obviously the risks are much higher. So if you have a good low drawdown, then you can at least have the big holding power in case of big swings. Of course, risk management is very important in terms of the stop loss and take profit positions that you want to have. Patience and determination is also very important when you're doing a trade. And most importantly, don't let the emotions overpower you. And that's the advice that I would like to give.
Yeah, it's a lot of good advice from my colleagues here on the panel. I'll take this opportunity to play devil's advocate a little bit and say, I don't think there is a strategy that works for all markets. There is no one-size-fits-all that works in all market conditions. So a key I would like to highlight is adaptability. You have to adapt to different market conditions that can change from day to day, week to week, or month to month.
Well, it's really difficult to be at the last. I agree with most of my colleagues. Just spoke about how to build the strategy, but it's like in terms of taking the risk control in consideration, set of psychological restrictions and rules for yourself as a person, what's good for you, knowing the good time to trade, and knowing the best timing of the day to trade is very important also with the opening of the exchange and so on. Also, it's very important to have a good strategy, I mean like a technical strategy that help you to enter and exit the market, and you keep monitoring that strategy and adjusting and adopting as well the new change, and keep developing this strategy with the new market circumstances and new market conditions. Because if the market keep moving and changing, and the patterns, even the patterns that we've been trading based on like 5 years ago, those patterns changed now, and you have more confirmation, or you need more confirmation to trade a certain pattern in the technical side. Lastly, the news, and following up with the news that taking impact and affecting the market very well. You should monitor those stuff. I think those are the main principles of any trading strategy.
Right on, and we'll send the last question back over to you, Mr. Mahmoud. What can a trader expect from brokers to make the trading more comfortable in circumstances like this?
First of all, everyone wants low spread. Everyone wants a very good coverage from his broker about the market news, the market movers, the market update, kind of market rundown that every trader can know what's going on in the market. And also, a trader needs a very good customer support. So if his broker providing him a very good customer support, so he can keep going, following up his trades. So yeah, that's it pretty much for me.
Thank you.
Okay, so what matters the most in volatile markets definitely is the execution. So whenever you want to execute a trade, you definitely don't want to get filled a couple of points away from your initial price target. So definitely, brokers will have to do first is just give a client a very fast and proper execution, and then it comes to spread. So usually this just comes a bit of a controversy. So when the spread is almost high, sometimes a broker can give you a better execution, and vice versa. So usually when a client have a proper spread, proper execution, this is what he needs in terms of placing a trade from the broker. And then I'm going to move to the other point that my colleague just highlighted, is all the information that a client can get from the broker. Definitely some brokers, they have terminals, they have some access to proper research where a client doesn't have this access, or it can take him, he needs to spend some money maybe to have such resources. So when a broker shares this information with the client, he's gonna definitely be satisfied, and then maybe he could be a bit not a step ahead, but maybe more comfortable than if you'd be looking for the information alone. So a key, good spreads, good execution, and proper knowledge from the broker.
Excellent.
I mean, what the client expects from the brokers, irrespective of whether the market conditions are volatile or flat, are typically the similar ones. I mean, all clients would expect fair price, fair execution, and a good customer service. That's important, brokers. And let the brokers not, I mean, especially in these trying times, the brokers should not oversell themselves there. And especially on the leverage part, because the higher the leverage you give to the clients, it's quite possible that the clients may lose out completely. So if you don't oversell, you have a fair price, fair execution, you are transparent with your clients as to what you are offering and what you're going to charge them, that's what the client wants. And obviously what's happening in the industry, most of the clients complain about the time of withdrawals. So if you can give a speedy withdrawal in these times, I think all the clients would be more than happy.
Fantastic.
So, you know, everybody touched on the fact that volatility creates opportunities in the market, and there's no doubts about that. However, it is the broker's responsibility and duty to proactively inform their clients about the associated risks that come with volatility, because it's not one-sided. So make sure the clients understand you know, the risks associated with, the elevated risk associated with volatile times. Obviously providing a good technical and fundamental analysis and market research to their clients to ensure that they're always, you know, up to date on what's happening in the market, you know, and support them in their trading activity along the way. We, at ADSS, we actually have a separate department, a 24-hour trade support department that consists of 10 individuals that are there to support the clients, you know, around the clock. One last point, you know, some clients might actually not like the fact that, you know, as you see, when the market's very volatile, you'll see a lot of the brokers, I believe most of the people on this panel as well, they alter the margin requirements. And I think they should, and it's their duty to alter the margin requirements, because that not only protects the broker, but it actually protects the clients, you know, from over leveraging themselves during volatile periods.
Well, it's like, as I said, volatility is creating opportunities, and volatility is something good for traders, and they keep searching for that kind of volatility. The last thing a trader who is searching for volatility and waiting for it to happen, the last thing he wants a broker that he can't help him or stand with him or ease the way for him to take that opportunity in the best manners and the best, let's say, conditions possible. So what a broker should provide a lot. It's like the broker is everything for the trader. He's providing him with the platform. He's providing him with the requirements. He's providing him with the good and perfect technology that works with all kind of market conditions. that make him able to execute his trades safely, and also a broker that he look for his clients and take care of them when he increased the margin requirements. He's not increasing for himself, he's increasing for the safety of your positions as a trader, for your safety as a client, and your deposits and funds. Some traders, they might underestimate these conditions that the market is moving in, and they take extra risk while without the interventions of the brokerage firms when it comes to increasing the limits of margin requirements or restricting the trades sometimes, he will not be disciplined enough to manage to get out and through this market volatility. So it's very important the restrictions that being put by the brokerage firm, and also to be more informative and educative as much as possible as a broker for their clients and leads.
Excellent. Well, fantastic answers from each and every one of you. Ladies and gentlemen, that brings a conclusion to our first panel discussion. Round of applause for our speakers here up on stage. Again, over a half century worth of expertise that's just been shared with you guys. If you have any more questions for any one of our speakers, their booths are located in the hall next to us. We do have another speaker that will be jumping on stage here momentarily. Again, momentarily. Thank you again, speakers.